Preparing for a Johnson & Johnson FP&A interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A mean to you, and how does it support a healthcare business like Johnson & Johnson? FP&A connects financial information with operating decisions. At Johnson & Johnson, I would help leaders translate commercial, clinical, manufacturing, and market assumptions into forecasts and resource choices. That includes budgeting, monthly performance reviews, variance analysis, and scenario modeling. I would not view the role as simply reporting results. I would explain what changed, why it changed, and what management can do next. Strong FP&A ultimately improves accountability while supporting sustainable growth and responsible healthcare outcomes. While answering, focus on planning, forecasting, performance analysis, decision support, cross-functional partnership, and the importance of balancing growth, margins, innovation, patient impact, and compliance in healthcare. Question 2. How would you build an annual budget for a Johnson & Johnson business unit? I would begin with strategic priorities and the planning calendar, then build the budget from operational drivers rather than arbitrary percentage changes. For a healthcare unit, I would model product volume, price, mix, launches, market access, manufacturing costs, headcount, research investment, and risks. I would challenge assumptions with commercial and supply chain partners, reconcile bottom-up plans to leadership targets, document decisions, and run sensitivity cases. The final budget should be transparent, measurable, and connected to ownership. Make sure to cover the planning calendar, bottom-up operational inputs, top-down strategic targets, revenue and cost drivers, assumptions governance, challenge sessions, consolidation, approvals, and communication of final commitments. Question 3. How do you forecast revenue for a pharmaceutical or medical technology portfolio? I would forecast revenue using a driver-based model, separating volume, price, and mix. For medicines, I would consider patient starts, persistence, indications, payer access, competition, patent events, and launch curves. For MedTech, procedure volumes, capital equipment demand, utilization, and geographic mix may matter more. I would validate assumptions with sales, marketing, market access, and supply chain teams, then create base, upside, and downside cases. Forecast accuracy improves when assumptions are explicit and regularly refreshed. In your answer, talk about volume, price, mix, market share, indications, customer or payer dynamics, launches, patent or competitive events, seasonality, channel inventory, and probability-weighted risks. Question 4. What is your approach to explaining a monthly forecast variance to senior leadership? I start by separating the variance into price, volume, mix, timing, foreign exchange, and cost driver effects. Then I determine whether each item is temporary or likely to change the outlook. For example, a sales shortfall caused by delayed orders requires a different response than declining market demand. I would quantify the impact, confirm the explanation with business owners, recommend actions, and update the forecast where appropriate. Leadership should leave knowing the cause, consequence, and response. Be sure to mention materiality, price-volume mix analysis, timing versus permanent changes, operational root causes, financial impact, corrective actions, accountability, and a concise executive narrative supported by evidence. Question 5. Describe how you would partner with a commercial leader who disagrees with your forecast. I would first understand the commercial leader's assumptions and the evidence behind them. Often, disagreement reflects different definitions, timing views, or confidence in a launch. I would reconcile the data, identify the specific drivers, and model both perspectives rather than arguing over a single number. If uncertainty remains, I would present a range with clear probabilities and leading indicators. My goal is not to win a debate, it is to create a credible forecast and support a better decision. Focus on listening first, aligning on definitions, testing assumptions objectively, using shared data, separating advocacy from evidence, modeling scenarios, and preserving a constructive relationship while maintaining forecast integrity. Question 6. How would you analyze a gross margin decline in a healthcare product line? I would decompose gross margin into price, volume, mix, manufacturing efficiency, input costs, freight, foreign exchange, rebates, and overhead absorption. A product can show revenue growth while margins decline because lower margin products or markets grow faster. I would compare actual performance with standard costs and prior periods, then partner with operations and commercial teams to identify actions. Those might include pricing, sourcing, yield improvement, mix management, or demand shaping. I would quantify each action and track execution. Cover price, volume, product mix, manufacturing yield, material and freight inflation, labor, royalties, rebates, utilization, foreign exchange, overhead absorption, and actions to recover margin. Question 7. What is a driver-based forecast, and why is it preferable to simply applying a growth percentage? A driver-based forecast links financial outcomes to measurable operating assumptions. Instead of growing revenue by 5% automatically, I might forecast units, price, market share, procedure volumes, or patient demand, then calculate revenue from those inputs. Costs could be tied to headcount, production volume, materials, or activity levels. This approach makes assumptions visible, allows meaningful sensitivity analysis, and gives business partners ownership of the variables they influence. It also makes variance explanations far more actionable. While answering, define operational drivers, explain transparency and accountability, distinguish controllable from external assumptions, discuss sensitivity analysis, and connect the approach to forecast accuracy and business decisions. Question 8. How would you evaluate whether a proposed healthcare investment creates value? I would evaluate the investment through both strategic and financial lenses. I would estimate incremental revenue, gross profit, operating costs, capital spending, working capital, taxes, and timing. Then calculate NPV, IRR, and payback using appropriate risk assumptions. In healthcare, I would also consider regulatory feasibility, patient needs, launch uncertainty, manufacturing capacity, and competitive response. I would compare the proposal with alternative uses of capital and define milestones so performance can be reviewed after approval. Make sure to cover strategic fit, incremental cash flows, timing, risk-adjusted returns, NPV, IRR, payback, capacity, regulatory considerations, opportunity cost, and post-investment performance measurement. Question 9. Tell me about a time you improved a budgeting or reporting process. In one role, the monthly forecast relied on multiple spreadsheets with inconsistent assumptions and significant manual consolidation. I mapped the process, standardized driver definitions, created a controlled template, and automated recurring data checks. I also held short training sessions so business owners understood both the model and their responsibilities. The close-to-forecast cycle became faster, errors declined, and review meetings focused more on decisions than reconciliation. I would bring the same process discipline to a complex healthcare organization. In your answer, use a clear situation-action-result structure, quantify time or quality improvements, explain stakeholder adoption, describe controls, and show how the change improved decision usefulness. Question 10. How do you distinguish a forecast variance caused by timing from one caused by a fundamental change? I investigate the underlying activity rather than labeling every variance immediately. I would review shipment timing, customer orders, backlog, production schedules, accruals, and historical patterns. If revenue moved because a shipment crossed month-end but demand and orders remain intact, it may be timing. If cancellations, lower utilization, or weaker market data persist, the issue is more fundamental. I would communicate the distinction clearly, monitor leading indicators, and revise the forecast when the evidence supports a lasting change. Be sure to mention transaction schedules, historical patterns, backlog, order and shipment data, revised operational assumptions, persistence across periods, and updating the outlook only when evidence supports permanence. Question 11. How would you analyze working capital in a Johnson & Johnson operating business? I would analyze working capital through receivable days, inventory days, payable days, and the cash conversion cycle. For inventory, I would examine demand accuracy, safety stocks, lead times, expiry or obsolescence, and service level requirements. For receivables, customer mix, payment terms, disputes, and collections matter. I would partner with sales, procurement, and supply chain to identify practical actions, recognizing that excessive inventory reduction can create shortages. The objective is sustainable cash improvement without compromising patient access or operational resilience. Focus on accounts receivable, inventory, accounts payable, cash conversion, customer terms, supply reliability, obsolete stock, demand forecasts, payment practices, and trade-offs between liquidity and service levels. Question 12. What would you include in a monthly business review for a healthcare segment? I would structure the review around the story of performance, revenue, gross margin, operating expenses, cash, and key operational indicators versus budget, forecast, and prior year. I would highlight volume, price, mix, launches, supply constraints, productivity, and major risks rather than overwhelm leaders with detail. Each variance would have an owner, implication, and action. I would finish with the updated outlook and decisions needed from leadership. A good review turns reporting into an operating conversation. Cover financial results versus plan and prior year, operational KPIs, revenue drivers, margin, cash, risks, opportunities, forecast changes, accountability, and concise actions linked to leadership priorities. Question 13. How would you model the financial impact of a new product launch? I would build the launch model from market opportunity and adoption assumptions, not just a top-down revenue target. Key inputs include launch timing, eligible patients or procedures, penetration, price, payer access, geographic rollout, competition, manufacturing ramp, salesforce costs, and potential cannibalization. I would use base, upside, and downside scenarios, with probabilities where appropriate. After launch, I would compare actual leading indicators with the model and update assumptions quickly, especially during the first several quarters. Discuss launch timing, adoption curve, pricing, market size, indication or procedure volumes, payer access, cannibalization, salesforce investment, manufacturing ramp, probability scenarios, and post-launch tracking. Question 14. How do you ensure accuracy and control in an FP&A model? I build models with clear. Mention clear ownership, source data reconciliation, standardized definitions, version control, formula checks, reasonableness tests, access controls, documentation, review evidence, and separation of assumptions from calculations. Question 15. How would you handle foreign exchange in a global healthcare forecast? I would separate underlying business performance from foreign exchange effects. First, I would forecast local currency revenue and costs using operational drivers, then translate results using approved planning rates. I would show reported and constant currency views so leaders understand what the business actually delivered. I would also identify transaction exposures, geographic mismatches between revenue and costs, and sensitivities to major currencies. If hedging exists, I would coordinate with Treasury, but I would not confuse hedge results with underlying operational performance. In your answer, distinguish transaction and translation exposure, constant currency reporting, rate assumptions, geographic revenue and cost exposure, hedging context, sensitivity analysis, and operational versus purely currency-driven effects. Question 16. What KPIs would you monitor for an FP&A business partner supporting MedTech? For MedTech, I would monitor procedure volumes, market share, unit growth, price, product mix, capital equipment placements, utilization, service revenue, backlog, and gross margin. I would also track inventory turns, forecast accuracy, quality indicators, returns, and launch adoption. The right KPI set depends on the business model, because recurring consumables behave differently from capital equipment. I would connect operational measures to financial outcomes so leaders can see which actions influence revenue, margin, cash, and long-term share. Cover procedure volume, market share, sales growth, price and mix, backlog, utilization, service revenue, gross margin, inventory, quality, product launches, and customer or hospital purchasing trends. Question 17. How would you support cost reduction without damaging innovation or patient outcomes? I would start by separating productive efficiency from reductions that create hidden risk. I would examine procurement, manufacturing yields, process automation, organizational layers, discretionary spending, and portfolio priorities while protecting quality, regulatory compliance, essential research, and patient access. Each initiative should have a baseline, owner, timing, and verified financial impact. I would model both savings and potential consequences, then monitor service, quality, and innovation indicators. Sustainable productivity is better than a short-term cost cut that damages future growth. Focus on targeted productivity, zero-based challenge where appropriate, process efficiency, sourcing, automation, portfolio prioritization, quality safeguards, regulatory compliance, and measuring sustainable savings rather than indiscriminate cuts. Question 18. Describe a time you had to present difficult financial information to a non-finance audience. I once presented an unfavorable forecast to an operations group that initially viewed finance as overly negative. I translated the variance into production volumes, overtime, and customer service implications, then separated confirmed facts from assumptions. Rather than presenting a dense spreadsheet, I used 3 key drivers, a visual bridge, and proposed actions. The discussion became collaborative, and the team agreed on a revised production plan and monitoring cadence. I learned that clarity and respect are as important as technical accuracy. Use a specific example, explain how you simplified technical content, connected numbers to operational consequences, handled questions, maintained credibility, and secured agreement on actions or decisions. Question 19. How would you prioritize competing requests from commercial, supply chain, and R&D stakeholders? I would first clarify the decision, deadline, required resources, and consequence of delay for each request. Then I would rank initiatives using strategic fit, patient or customer impact, value creation, risk, regulatory considerations, and resource capacity. Where data is incomplete, I would use scenarios and identify the assumptions that matter most. I would make trade-offs visible rather than promise everything, align with leadership priorities, and escalate conflicts with a recommendation and supporting analysis. Be sure to mention strategic alignment, patient and customer impact, financial value, urgency, risk, resource constraints, scenario analysis, transparent trade-offs, and escalation when decisions exceed your authority. Question 20. Why do you want to join Johnson & Johnson in an FP&A business partner role? I am attracted to Johnson & Johnson because the finance role sits close to businesses that affect patients through medicines and medical technologies. The scale and complexity would let me apply rigorous planning while learning how innovation, regulation, supply chains, and commercial execution shape results. I also value the opportunity to partner with non-finance leaders, challenge assumptions constructively, and turn analysis into action. My strengths in driver-based modeling, clear communication, and accountability would allow me to contribute quickly while continuing to grow. In your answer, connect J&J's healthcare mission, scale, innovation, operational complexity, disciplined finance culture, cross-functional exposure, and your own analytical, communication, and business partnering strengths. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.